Well, hello there. Welcome to the Pruskop Podcast. My name is Megan Prusko. I'm a realtor here in Edmonton, Alberta, and I focus on helping people achieve their investment property goals with their portfolio. Today, we are talking to Andrew Galler. He used to be a residential mortgage broker. Now he is specializing in CMHC MLI Select mortgages as a lender. We talk about the comparison between residential and commercial loans. I hope you enjoy the conversation just as much as I did. Welcome, Andrew Galler, to the Pruskop Podcast. Ta-da! Today we're going to be talking about residential versus MLI Select mortgages. MLI Select is still fairly new to a lot of people. It's becoming very trendy, but there's a lot of misinformation or just lack of knowledge about it because it is a very detailed program. Where did you get started in mortgages and loans, and what did your path look like with that?
Yeah, so started back in 2012, I guess it is. I had graduated university and moved out west here from Halifax, and I was away from the banking. I did start out in banking. I went away from it, and then a friend of mine, I was doing different kind of sales roles, mentioning that there's an opportunity at CIBC. And oddly enough, it was like a mobile role. It was something that it had a commercial component to it as well, and it sounded really interesting. So I ended up going and signing on, and I did that for 5 years and change, and then decided to do what most bankers do, I think, in that industry, which is I went out on my own and became a broker. I did that for 6 years with residential from anything from first-time home buyers, construction, 5% down, the whole gambit that way, as well as commercial as well. I still always need to maintain both parts. And yeah, and then from there, this opportunity come work with PKO Capital came about, and that's where I am today.
So you're focusing on MLI Select mortgages right now. Why is that your specialty?
It's been specialty, whether it's one of those things that just came to you, because it seems like every third, or not even that, every conversation I have a day almost somehow revolves around, or someone has a question about it. I feel like I'm like the weatherman. Everybody wants to know what the weather's going to be like tomorrow. They want to know more information about the program, and it's something that's extremely appealing in the sense of, where else can you put down as little as they're offering to have an investment property, and it doesn't exist anywhere else. Like, I've had some people from the States ask me like, hey, how do we get it? And I'm like, you don't. It's unique up here. It can be a great way to grow your portfolio in a very quick, very expedited manner.
With these deals, the financing is going to be what makes or breaks the deal. So what is your track record with getting MLI Select applications turned into approved loans?
Let's look for some wood around here. My desk is metal, and knock on wood, I haven't had any knot go through.
Wow.
At this point in time, I hope to maintain that track record. Of course, I know that's going to be a challenge because things can and will happen, but I think a lot of that comes down to doing the extra due diligence up front. I do spend a lot more time probably than other people in my role with looking at the information and double checking as much as I can to make sure the devil is in the details. And this is 100% that. This kind of financing, one of the ladies that works on our company, she always says, this is not always a science, it's a bit of an art. And then, of course, the team behind me, we got the brain power as well as the money, which is important, but we have the brain power behind us that if I don't know something, I've got a great bunch of resources to call upon and ask, hey, has this come up, or we seeing this? And collectively, we do share a lot, which really helps, because as a company, we did, I think someone said today something like 600 loans or something, but we were just shy of, I think, $7 billion worth of business. And most of that, a very high percentage, was CMHC and MLI Select.
So to date, you have a 100% track record with getting these loans approved.
Far, yeah.
Oh, that's amazing.
That's a tough one. That's a tough one. Yeah, so.
And just you yourself, how many loans are you handling right now, roughly?
I think right now I'm working on somewhere in the range of about 25 or 26, I think, with another handful that are just early days, or they're actively working and trying to get a deal done.
And right now you're juggling one of my files as well.
Yep.
I'm helping a buyer buy 2.1 just about $1 million 8-unit here in Edmonton. We were speaking about MLI Select mortgages, but for people that are going to be watching that don't even know what that means, can you give me just a very general overview?
Yeah, so very high level, it's a program put through CMHC, and very high level, it enables you to potentially put down as low as 5%, somewhere between 5 to 15%. as well as getting it extended amortization. So anywhere from 40 to 50 years amortization. And very much like the residential space, you would pay a premium to CMHC to do. So it enables you to buy investment properties for what almost like you can do residentially.
Yeah, so you can basically leverage more on bigger projects.
And that's what they want.
Awesome.
This is what they want, because we're still struggling nationwide when it comes to inventories. And this is a way of encouraging people with money and capital to come off the sidelines, buy 2 or 3 or 4 or 5 or however many of these properties you can, because we need the inventory and we don't have it. So this is a way of doing it. This program will facilitate. It is happening. It does take time. It doesn't happen overnight like anything, but this is what this program is meant for. So when people say, well, can I get 2 or 3? I'm like, as long as you can qualify, yeah, 2, 3, 4, 5, whatever the magic, whatever you can qualify, whatever you're capable of doing, of course, as well. But that's the objective of this, where, not to jump too far ahead, but it just jogs my memory for residential. I've been around long enough in that space where when I first got in, it was buy a rental property. People were buying homes, or duplexes and condos and fourplexes. Banks we were very much doing a ton of that business. And I did do a lot of that myself. The issue became is that they eventually moved away from that, because like this bucket of money, if you want to call it, is more of a residential space, not commercial. So they moved away from what they call professional landlords. So the idea behind buying 3 or 4, 7 or 8 condos, whatever the case may be, whatever your strategy is, has really gotten difficult, where this avenue is almost paved the way where you can get into this much easier within the rules and put down less and get more. So it does really make a lot of sense.
Yeah, this program is really meant to incentivize people with high net worths to, exactly what you said, get off the sidelines and start helping with the housing crisis we have. What kind of properties are available to get financing through MLI Select?
5 units and above. So if you got a 5-plex, 6-plex, anything up to 130 units, I don't know if there's a limit on it. Never heard of it. A couple 100 units. That's what you're looking at. Anything 4 and under still technically falls under the residential bucket. So if you got a 4-plex, you got to go residential.
There's also 3 categories when it comes to MLI Select, and that's how you're going to score your points. The more points you have leading up to a maximum of 100 points gives you the better financing structure, the best that you can get. What are those 3 categories?
So the 3 categories, I'll go from, we'll just say least popular to most popular. So I would say the accessibility is the first one. That revolves around making your building, just a very simply put, I use the example of like ramps, lower countertops, things that make it more accessible for people that require that. I don't think I've even seen one yet, to be very honest with you. I haven't seen one qualify. I haven't seen anybody offer it or even build with that. I'm not saying they don't exist. They're just not as popular. The next one up would be energy efficiency. That one used to be a little bit more popular, but recently the recent changes to the program made it where you don't get as many points anymore for it. So that would be building green, or having, better windows, having solar panels, like things like that are green, that you can qualify. The most easiest one, and in my opinion, the path of least resistance in most cases, is the affordability. And that involves having a certain percentage of your units falling below the CMHC guided rent maximum number on a monthly basis that will allow you to achieve enough points. It doesn't require any structural changes to the building. Where if you start doing things like adding solar, I think it's great. I'm all for it, but it can be very expensive, especially after the fact, or to retrofit it. So for example, if you're buying an 8-plex, if you're buying a brand new 8-plex, for example, 2 of your 8 units would need, under new construction, would need to qualify for the affordability. If you're buying a existing property, which either has been around for a number of years or has been fully rented since it's been constructed for a year or more, in that case, you would need 7, technically 7 of your 8 units would need to be under the affordability. And I can go a little bit further in why that may not necessarily make sense for some people, but I think the numbers would bear out why not necessarily the best option, why the other form of new construction is a better way of trying to getting into the program.
And affordability is the only category left where you can get all 100 points anymore, because they recently made changes in, was it July?
Yeah, they made some in July. They came in effect, and then they had another round here late the fall here from a couple other changes they made. And the people ask me, like, when's the next change is going to come? They could send an email tomorrow saying, hey, next month we're going to release a new advice. They very much modify the program as they see fit, and it is a government program. It is what it is.
I do want to speak to why specifically Edmonton, Alberta is an incredible place to use MLI Select to the fullest extent. As you said, having the affordability category as the path of least resistance. Here in Alberta, we make the highest salary out of all of Canada, and our homing prices are one of the lowest ones. So our cap that we have for what counts as affordability, it's 1665 per unit, right?
Yeah, the new number actually just came out here. But yes, you're right. We do have really good, strong income. And as far as our rents and cost of living, it's still relatively very affordable compared to various other points in the country.
Because MLI Select for affordability, they don't look at if it's a 1 bed, 2 bed, 3 bed. Is it a basement, a main floor, an apartment? They just look at it as a unit. So here in Edmonton, I'm yet to see a 1 bed basement, new or old building that can charge 1665 for rent anyway.
Yeah.
So you aren't sacrificing any potential rent income to get underneath that. You're already maxing out what you can charge, and you're still under that cap. So you're not losing any money. You just automatically qualify.
Yeah, that's the advantage. Where other places you're not able to do that. The numbers don't work as well. You don't want to pick on any other provinces, but it's just a case where in Alberta, it very much, and particularly in Edmonton, it very much falls into that. Yeah, because I'm not seeing too many basement suites they're getting much more than maybe $1,300. So you designating 2 of your 8 units for affordability it's not really affecting you that way.
Now, there is a caveat on that a lot of people don't realize is when you agree to using the affordability category, you have to lock that in for the next 10 years.
Yes,
that's a lot of people, they look over that part. Nope. But as the years go on, if that limit does get increased, then you can increase your rent up to the new cap.
Yeah, and they base it essentially off the Canadian price index. That's the magic, because we don't have rent control in Alberta, which is part of the reason why it's so attractive here. Places like I was just looking at a deal today with a colleague of mine in Vancouver, and the rents were, I don't know how it was happening. It was like 900 and change on a basement unit. And we were looking at each other like, how is that possible in Vancouver? The most they can increase it, I think it was 3.5% a year. So even if you wanted to pop up the rents, you can only do so by, I think it was like $30 something a year. So you're really stuck. Where in Alberta, if you came into a property that was really underperforming like that, you could very quickly raise the rents and still be compliant with the affordability program.
Something else that makes CMHC MLI Select, or just commercial mortgaging in general, more attractive than residential is the lenders look at different categories to qualify you, or different variables to qualify you. So if I am applying for a residential mortgage for an investment property, what is the most important thing that the lender is going to look at for me?
On the residential side, they look at obviously who you are first. Okay, what do you do for work, your credit score, your income, how long you've been working there. And then they look down to other aspects of it in a little bit of detail. And then, of course, they look at the property. And then if it's an investment, they'll look at the amount of rent that you're bringing in, and they'll discount the rent in other ways. And you still have to qualify the traditional way in the residential side with the gross debt income and total debt income servicing ratios, which can make it challenging because unless you're making a lot of money, you can't carry a whole bunch of properties, right? So where versus the commercial end, the first thing I asked a question about do you have the 25%? Can we figure it out if you got the equity requirement, the loan amount? And then it's really quickly moving on to what's the building look like? Let's start running the cash flow numbers to see what kind of loan to value you could get. So the building you're still very much an important factor in the loan process, but I think that what you need to realize is they look more about the cash flow of the building. And then of course you are a part of that equation, but the building really needs to, where in the residential side, it's almost an afterthought. We don't have the ratios that are required in the residential space, which makes it challenging once you get beyond a certain amount of doors. And of course, residentially, depending on the institution, some of them have maximums, like you can only have 4 doors. That really limits you. And then you can look at other lenders. They say, okay, you can have 10 with us. Okay, then if you're trying to really build a portfolio, it really makes it very difficult and challenging, and also limits you on how many properties you can have if you're looking to really try and build a large portfolio.
So just to make sure I can summarize this correctly, when you're applying for a residential loan, the main thing that they're going to be focusing on to qualify you is you yourself as an individual. What is your income, your credit score? And then they look at how the building performs second. and then they'll adjust based off of that. In
I think that's fair too.
commercial,
Yep.
it is geared towards a lot more of how does the property itself perform, and then they check you second to make sure that you also qualify and are compatible with that property.
Yeah, because the building doesn't work. You could be the best, strongest applicant in the world, but if the building doesn't work, or the building has some other underlying issues, as a lender, we're not interested in continuing.
If I was a new client coming to you, I'm like, hey, Andrew, I want to put 5% down on an apartment building. I love this program. What are you going to ask me to loosely pre-qualify me?
Again, I think the first thing would be is, I guess, what kind of experience you have in real estate.
I'm a brand new investor. I have some money, but I have no experience.
Yeah, so then I would ask, okay, so do we have we asked about the 25% equity amount of the loan requirement, what that breakdown looks like, because I've had some people approach me. I've got a little bit of investment money kicking around, but not much. That can quickly dispel it, or we may need to do some refinance there to make the numbers work to give you enough cash. Get understanding what your experience is in life to an extent in business to get a sense of your character. I think that's very important. And then from there is just to understand what is your goals here. Do you want to buy a bunch of these? Is this a one-off? What is your general attitude to investing? I think that's important to this as a starting point anyway.
So you actually ask a lot of big picture questions then. Usually when I meet potential clients that are interested in purchasing multifamily, the three questions I ask them outright: A, what is your experience? Same as what you said. If you have experience, that's better. If you don't, you can always just sub it out to a property manager. So it's not a make or break, but it'll definitely strengthen your case. The second thing I ask is, what is your net worth? Whatever your net worth is, times it by 4, and that is the maximum loan that you would be able to get, assuming all the numbers line up with that. And then the third thing I ask is, what money do you have liquid or available? Because the closing costs, I usually tell people to budget anywhere between 8 to 13%, because it'll be somewhere between 5 to 10% down. And then also budget roughly 3% for closing costs. That's to be safe. And if they go with you, who is a lender, not a broker, then they can save an additional 1%.
Yep.
Yeah.
No, those are all good points. When I think the further you get down, then you dial in need for further. And I also like to get statements where I can. I know it's part, depending on how far along we are on the process, I do like to get that, because I can't tell how many times people say, oh, I've got X 100,000 here and there, and I get the statement, and it's so it's what's the saying is what you can prove, and that's very important, because unlike residential, because we're going back and forth on comparison of this, is that in residential world, like when you're doing applications, I can list out 10 assets that I have. I just list it. I never submit it. Like, as far as like actual documentation in this space, we 100% verify everything you say. So if you say to me, hey, I've got 100 grand and a TFSA at ATB, I'm getting a statement to verify that. That's the requirement, 100%. If you've got a rental property, we need documentation on it: mortgage statement, property tax bill, lease agreements. We need to see all this documentation to verify the net worth, which is half the battle, particularly with new investors. I do warn them up front, and I use this phrase a lot, and they think I'm joking. I'm really not. I said, I'm going to paper you to death. And I think the way I look at it is, if I tell you that, and when I do it, then he did say he was going to ask a lot of paper, because I don't want to sugarcoat it, because it is a lot of paperwork. Some of my files are anywhere from 600 to 900 pages. And that's not anything egregious. The more rental properties you have, you think about a lease agreement can be 10 pages. You've got 10 of them, it adds up pretty fast. But these are some of the things that, like, as far as differentials goes, and things that we're talking with new investors that they need to be aware of. And I do like your bit about closing costs. That is important. It's not something I go into as much. When I start looking at some of their statements, and if I don't see they have a lot of that room, it's going to be, hey, I see that we're putting down 250. You got 275 in your accounts. Where is the rest of your money that's going to go towards paying for an appraisal, an inspection, the lawyer, lender fee? Like, where's all this money coming from? Because it's a little bit easier sometimes to have the conversation once you have all those docs in front of you.
So financing through CMHC MLI Select, I do believe it's tailored towards more of the experienced people, or at least high net worth people. Do you feel like it is a beginner-friendly program? If I had a lot of money, maybe I got an inheritance, that I could just jump straight in and buy an apartment building for my first property. Is that realistic?
I think it's possible. Like I said, of course, actually, I think my current 4 deals that are in Edmonton, they're all first-time investors.
Wow.
Generally speaking, in the real estate terms, they are not seasoned veterans. So this program is available for those folks. The hope is that you get the experience from this particular property and that you move on and do other ones, because not everybody is going to be a real estate mogul. And that, look, if you are, that program is for you as well. But it also affords people that do have the money to get, like I said, get off the sidelines, invest in real estate, get more inventory into the market so people have a place to live. And I think it's very important. It really is, because people living in their cars or in places or couch surfing. I'm still surprised it happened in this country, really, when you look at it in general. But it's sad, and we need to fix it. And part of the way of doing it is this program.
Absolutely. I am actually really glad that the government did something that incentivizes investors. I
Yep.
know a lot of investors feel like they get penalized over and over again.
Yeah.
So for creating a program that is friendly and is, incentivizing people to put their money in and help out the government and help out each other
Yeah.
while also benefiting themselves, I think beautiful idea. Congrats to them. That was a great
It's
idea.
good. And I hope they keep it up for as long as they can, and until we get the vacancy levels to healthy levels, that if you want a place, you should be able to find a place. And I know Edmonton is building a lot. They've got a lot of great programs and some really good, new communities that I've gone through quite a bit. I've learned a lot more about the newer communities in Edmonton as I've driven through them, and I think it's terrific. And the more of it, we need more of it. It's just bottom line.
What do you see typically as the turning point for investors that are already in residential, but they want to make the switch to MLI Select?
I think part of what it is, you just hear it in the news so much that it's almost become trendy. There's a lot of folks looking online and talking to their friends, and I think some of the other investors that I'm working with, doing a few deals in Red Deer, a couple of the couples that I was talking with, I think one guy had a triplex and then they had a duplex, and they were looking at considering, they had some money available, equity in those properties, and they were looking, what do we do with this money? And the timing was really fortuitous. They were like, geez, we can go out and get, I think they're looking at a 21 unit building in Red Deer. And they were floored when I went over the fact, because they were really concerned about having enough income. And I'm like, income's not the question. It's part of the equation. We're not as concerned about that. We're looking more at the building again. And they were like, geez, we can get 20 units for what we thought we could only get another maybe fourplex for. That's an example of where getting an investor off the bench, if you want to call it, or investing more money and getting another building, is really, for those kind of investors, going to the next level. It's okay, now we have the ability to take 5%, or even, they think in their case, they have another ability to buy another building if they want to. They're like, wow, we went from 5 units to now we're going to go to 25 units. So it's available to do. It's just a matter of obviously doing the homework and making sure it all makes sense, and understanding the whole landlord aspect, how you're going to run that. I think there needs to be obviously a strategy around that, and it's an important piece. But if that's what you want to do, I don't know any other time where you can put 5% in on something, or 10%, or whatever the number in the middle, and get multiple buildings and build a portfolio. Because it used to be 20% of 5 million. You get $1 million kicking around is a lot of money, at least in my mind. Now you can do it for as little as $5 million building, 250. That's incredible.
I had a client ask me, we were looking at one of those new build multifamily 8 units together, and he said, do you really think it's worth the asking price? Because he wanted to go, I think, like 50K below or whatever. And he's, do you think it's worth it at this price? I'm like, dude, you are getting pretty much an apartment building for 5% down with 50-year amortization.
Yep.
Like, that is insane. Like,
Yep.
Even a difference of 10 to 50 grand, at the end of the day, you're going to be paying that off for the next 50 years. And people get really caught up in the purchase price upfront, rightfully so. It's still a lot of money. We're talking tens of thousands of dollars at least. But I know in the grand scheme of things, just the fact that this program is even an option for you is amazing. CMHC MLI Select, it has become very trendy. People are jumping onto the bandwagon. All they hear is 5% down, 1.1 DCR, 50-year amortization. But there's a lot of expenses or steps that they don't realize are a part of the process. So when you're speaking to a first-time applicant, what are some things that you tell them that they're like, I have to pay for that, or you need that information? What is a shock transitioning from residential loans to commercial?
Yeah, I think the biggest thing, I think the shock, if we're just talking about like a straight up purchase, like a new build, not talking about construction, that's a different animal. I think a lot of it is, again, the paperwork is a big shock for them. Like the amount, some of them are okay with it. Some are, what can we not do? And I'm like, no, everything on that list is relevant. Like I can't not have it. The time frames are longer. That's something that people really go, we're not gonna wrap this up in 2 weeks. And I'm like, nope, no, that's not how that works in this space. And the other thing is, yeah, the cost, you're right. There's legal, It is more expensive. The appraisal can run anywhere from 25 to 3,500 bucks. Potentially, I'm trying to think what they were like. They could be $400 or $500, $300 or something. So
And then the
it's gone a lot
inspections will
higher, right?
be around 4 and 5 grand. And if you're just
Yeah,
buying a primary home, it's $500. That's
yeah.
a lot.
It's
We
a
also
huge
talked
difference.
earlier about the lender and broker fees. So if you don't use Andrew, which would be silly not to do, if you went to a broker, then you're losing another 1%, which doesn't seem like a lot, but on a $2 million property, that's 20 grand that you just,
Yep.
it's gone.
Yep.
So
No, yeah. No, and you're right. You hit the nail right on the head. There's lender fee, which people are like, I'm not doing it because that's very common in residential for like other B or private lending. But for most folks that are A lenders, and most of the folks that we're talking about, in my opinion, will be A kind of style folks, A investors. They're not used to like a fee. Why am I paying this? So there is some education. I think a lot of that. So I think these are significant things. You think about it, like a fee, the costs are higher, the time frames are longer. So almost everything involved, the price points are higher. So everything is definitely larger in the commercial space compared to residential. So there is a bit of a shock there, but I think once folks get their feet in, I think they understand. Okay, I got in, and you look what you've done. It adds up, and a number of deals I've looked at recently for people looking at buying what I call legacy buildings or existing buildings. And I talk to the sellers a lot of times, just general conversation when I go to do my inspections. And I can't tell you how many times I walk in the building and it's an older couple or a gentleman or a lady, and they're like, oh, when did you buy this building? Oh, bought it back in 91. Oh, really? Had it since then? Yeah, bought it for 1.1 million. We thought it was so much money, and now they're selling it for 15 or something. What was it? One that was in, I think it was like 20. I think it was even more than that. And it was just incredible. And they're like, yeah, we bought it. We just held it. And the rents aren't even that high. Like they haven't raised rents in probably 4 or 5 years. So they've owned it in cash. So the thing I think investors, because they get a little bit tied up on some of the numbers and the years and stuff. I'm like, these are long-term plays. These are not 1 or 2 or 3. I even talk to people 5 years. And, oh, it's a long time. I'm like, in the space of this kind of product, it's not. Even the 10-year commitment, you talk about affordability. Yeah, it's a long time, but you're not really flipping this property in a year or 2 or 3 or 7 or 10. That's not the goal. If it is, it's a different strategy. And I'm not here to knock anybody's strategy, but when I look at a lot of these folks that are highly successful and who created generational wealth, it's based off them buying and holding for a very long period of time.
Yeah, even something as small as the negotiation period. Even negotiations take longer.
Yeah.
Like investment properties and residential, we can negotiate, and that day typically we'll come to an agreement and go pending, and we're good to go.
Yep.
In commercial, it just takes longer. And then you mentioned the financing also takes longer. So as of right now, how long does it take for CMHC financing?
I'd say like 8 to 10 weeks. I would say that's fairly standard. I've got a deal that I sent in, and I think it was end of October. I'm still waiting for an approval on, and I said other deals in the same time. I have approval, so that's the challenge. I know a lot of people will say things about them, and I've shaken my head a few times on some of the things they do, but their time frame it's not a 1, 2, 3. It can be many things, and it depends on volume. They did hire a lot of staff last year, and I know a lot of junior underwriters, which is great, and we need more of them, I think. But their time frames are time frame, and we have zero say. Any lender, even the biggest banks, RBC can call them up and say, I want this done. They're going to say, yeah, we'll get there. They don't favoritize people or lenders. It's you get into the queue, and I've had to talk a couple of people off the ledge a few times where this is taking forever. They don't want my deal. I'm like, it has nothing to do with you personally. This is just this is the nature of the beast when we're dealing with CMHC. And I think the more people understand that going up front, you'll just grin and bear it. That's the best way I can put it. I get it. I'm with you. I'm right there with you. I wish they were much quicker, and maybe they will be in the new year. I have hope that they will get there eventually, and they'll turnaround times will improve. But until that happens, we're literally all in the same boat. No one is getting any special treatment.
So timeline for financing in residential is right around 10 business days. It can be done in 7, like maybe even shorter if someone like really has the pressure on.
Yep.
But in CMHC, as you said, 10 to 12 weeks. Sellers always want to close as quick as possible. And they are not very favorable to allowing a 10 to 12 week pending period for the buyer to secure CMHC MLI Select funding. So what can buyers do to appease the sellers so that they can get the property but still get CMHC MLI Select funding?
So there's being prepared is half of it. I think if the more we can have them ready with their documents up front and have everything ready to go, it really makes a big difference because it's from the moment you sign that paperwork, as we've been doing this week, the clock is ticking right away. And it ticks louder the longer it goes. But in some cases, if you don't have everything they want, they'll just send it back to you and you go right back into the queue again. And that's 4 or 5 months just out the window. Not to get too technical with products, PKIL, we do have a product called bridge financing. It's very much the same way that residential bridge financing works, where you can, if you're looking obviously doing the MLI, we would underwrite it that way. And that's the only reason we would do a bridge, is that if the investors are able to come up with 25% down, we can close on that with a prime plus product with the express point of going to CMHC. And I have one of those right now where I'm just waiting for CMHC. And as soon as it's done, we will move them right from the product. It's an open product right into CMHC. So that's something they can do that can speed up the timeline. And then as soon as it's ready to go with CMHC, we'll just transfer them over with no penalty, obviously, to do so. Because that's the whole point of the program.
As I said, sellers don't want to wait 10 to 12 weeks. So there is a leap of faith that buyers have to take in just assuming that they are going to be able to get this financing. Yep. Typically, what I see on the realtor side of things is we find a property, they really like the numbers, they look at it more, we see it in person, they want to continue with the purchase, then we'll negotiate the price before we officially go pending. And then right before we go pending, they freeze and they're like, wait, I need to look at this before we go pending. And I'm like, no, don't do that. There is a due diligence condition in the contract.
Yes.
By you hesitating before you dibs the property by going pending, yep, you very well may lose out on this.
Yep.
Just get it pending and then complete your due diligence. Send this property to Andrew right before we go pending, and he'll overview it and let you know if there is any red flags that he can foresee with the documents we provide. And then he'll give you the green light or red light from there. Then you can move forward with confidence.
And yeah, I get it. I've bought several homes residentially and investment property, and I'm no doubt in my mind that I probably did the exact same thing where you're like, whoa, I'm about to spend how much on this?
Mm-hmm.
Do one of those double takes, but at the end of the day, it's all about the numbers. If the numbers work, the numbers work. The key there is to, do as much diligence as we can up front. That's very important, of course, but yeah, once we go under pending, no different than our recent example, we're getting the appraisal. That's going to be a big piece of this, and making sure we use the actuals and it all should all line up and everything based in the area should all work out. But having those numbers is really important. And if we don't have them, it's really difficult to do. I think I said to you a few times we've talked, I'm only good as the information I'm given. So if I've got good numbers, then the information I'm going to give you is as accurate as possible. And that's the way we can move forward.
So I want to highlight the contrast between how much a deposit you can leverage in commercial versus residential. So let's say my net worth isn't an issue. I'm big ball and rich. If I have $250K liquid or available, burning a hole in my pocket, I want to buy a property. What is the maximum amount I could purchase on the residential side as a rental versus MLI Select?
So residential, you'd be looking at about 1.25 million. And just we were thinking of how do you pull the number out of the air? That's just 20% down. Mm-hmm. And residential, that's going to be the requirement if you're buying an investment property. That's just bare minimum that I'm aware of. Sometimes it requires more, but that's the minimum you can get away with. If you're doing it with obviously the MLI Select program, the purchase price would be about 5 million. So the dramatic difference between the two. Bang for your buck. I don't know any much better than a 4 times multiplier. That's pretty good.
Yeah, so the same $250,000, if I wanted to buy a property in residential, I could buy a maximum of 1.25 mil, but in commercial, I could buy up to a $5 million building. And the more doors, the greater your NOI, and the less vacancy risk that you have, and all location dependent. There's a lot of factors to it, but just down payment alone, what you can do with your money, It's beautiful.
Yeah, it's substantial. And that's why this works. And that's why, like I said, some people will have a adverse opinion on the program. I've seen some of the recent information that's been shared with me. It does create another part of the market where, a lot of the stuff is going to get bought up. But again, we have the demand currently. And I think the program will adjust as things change in the market. Like they're not just going to let this thing run for 100 years. If you're looking at numbers wise and growing a portfolio, it's going to take you a lot longer to get four four fourplexes as opposed to one 60 unit building.
Mhm.
Those numbers don't lie. And the good thing about that is that you do that for 4 or 5 years or whatever, you can do a refi, then go out and do another one. And you've got the 32 building units within a 10 period. The multipliers work much better. And I like your point about vacancy. Well, 16 units under one mortgage as opposed to 4. If you lost half of it, you still have 8 rentals. You lost the other one, you only have 2. I don't know. I can't remember the last time I looked at a fourplex. It's been a while, but yeah, the numbers don't work as well. That's just the bottom line.
You mentioned that one of the longest parts of the process of applying through CMHC is getting the client documents put together.
Yep.
What documents should people be prepared to provide you?
So the big thing, the documents up front, is the verification of their net worth seems to be the biggest challenge for a lot of folks. It's pretty simple. If you got 3 accounts, you have to say the checking and savings is pretty easy. But it's when people have multiple rental properties, or they've got a lot of different investments, or had some challenges with structures of their corporations where there are multiple people involved in there. We need everybody's information to verify. So that's where documentation can get really complicated. But yeah, the more you have up front, even if you're buying a brand new building with a brand new corp, having your articles of incorporation, all the pages together in one spot. As far as your investments, at least having it all written out. So I want to give you a documentation, you can fill it out very quickly, and knowing that I'm going to ask you for a statement to verify each one. The sooner you have that, the better. These are biggies. These are big points. And if you've got in your taxes, we need 3 years. Normally, and I know in residential, you can get away with 1 or 2. In this space, it's 3. So you need your 23, 22, and 21 T1s and NOAs. Even if you're employed, you still want to see them. So that's a part of it. And as well, if you're incorporated, 3 years corporate financials. Notice the readers are fine as long as it's not too long of a large of a corporation. But so 3 years of that. So sometimes people really struggle with gathering all that information. And even just the list I rattled off to you, that's easily a couple hundred pages worth of documentation.
Yep. So basically, if people say that they have an X net worth, that you're not just going to take their word for it. You have to see proof of any money that they are claiming that they have.
Yeah, having that up front and having that organized, even just a folder. Like I some people like, just put in a folder. Even if you're just getting ready, you can have it all one spot. So the moment you're like, okay, I'm ready to go, it's click, click, and it's off. And I have it and I can start working on it right away. And the speed is the key. I know that we talk about time frame, that this is the classic example of hurry up and wait. It's our business and it drives people crazy. But the more you're organized up front, the quicker things go. We can find any issues up front. We can identify, or we can adjust. We can add an investor if we have to. Like, it's not like residential where, here's an example where if you're buying a home, maybe mom and dad won't co-sign for you. You're hooped. In this space, okay, we don't quite meet some of the requirements, or we want someone else. You can bring in another investor with you to sign on to beef up the application. There's other things we can do to help with that. But if we don't have all the information, again, it's no good. So as much as we need up front, the more up front, the better. That's just the bottom line.
I want to spin off that where you're talking about beefing up your application or how to make yourself look better, just more trustworthy to the lender.
Yep.
And I've heard that it is better to have multiple people on an application than just one. It just seems more secure to the bank. I've also heard if you are partnering with a property manager, that's a huge bonus. Or if you're partnering with a contractor, that is a really big bonus as well. Would you agree with that?
Let's just be honest. If you've got 4 people or even 2 couples, which is I see a lot of, two married couples, however that works, there's more strength there. There's 4 incomes. There's 4 individual net worths. It adds up to a lot more. So the likelihood of things going sideways is reduced. Or if it does, they have far more capacity to handle that. And that's just layered risk 101. And that helps. Now, as far as your comment about having a property manager, yeah, it wouldn't hurt you to have, hey, like guy on or lady on our borrowing group or our partnership is one runs a property management company. Great. Then we know you've got experience. No different than we've looked at some files where a gentleman was buying a property out to Vegreville, believe it or not, of all places. And we weren't really sure about it, but we saw the main applicant had been at a major bank for 15 years. We're like, okay, so he understands lending. Like we gave him some credence, and I think that really helped. It wasn't my deal as per se, but I think it helped him because he understands lending, and it wouldn't be a shock some of the things we're talking about, and understands the principles. So that helps. So yeah, so real estate experience, investor experience, banking, construction. Yeah, construction doesn't hurt either. But I think, yeah, any experience you have that is relevant will definitely speak to your character, which is important in this. And one of the things that I think most, if not all my deals, I talk to the borrowers.
Yeah.
Even if it's a broker involved, I will talk with them. I go put my hands on the property myself personally, or someone on my staff would. It's important that we've gone there, we've done our due diligence, and we've looked at the site and the building. Now, even if they're brand new, we still go look at them, which sounds crazy. It's like, hey, what's wrong with the brand new building? Still got
A lot can be.
touch it, right?
Yeah, I think that's something that a lot of people overlook as well in commercial is they figure it's more of a nameless, faceless game, but having a story of who you are, because the end of the day, even though a corporation's a separate entity, a corporation alone isn't going to be running or managing this property. It's going to be human beings.
Yep.
So what human beings are the lenders trusting with millions of dollars?
Yep.
That's an important thing to know.
One of the first things I ask for is a biography of the borrowers, which sounds really weird. Like, just write me a paragraph about your experience in general real estate, if you have any, what the plan is, and just to get a general. It's one of my requirements. So it isn't just the numbers work. It's we want to have the whole picture. Who are we involved with? Because one of the things I don't think, particularly first time investors don't realize, we actually do an annual review with you every year.
What?
So
I didn't know that.
Yeah, every year one of our folks from our servicing team, it would probably be probably Michael out of Calgary. We call up and we do a review. We want to know how the building's doing, or how are the numbers looking, and we do check in on this stuff to see how things are going. That's very standard for commercial lending, whether that be a retail plaza, apartment building, warehousing. Like, they all get annual reviews, because at the end of the day, as a lender, things can change dramatically. We would like to know but yeah, that's the thing that does happen on an annual basis. So we do call, and we hope that you would be able to send your financials over once your accountant's finished with them, because you are putting it into a corp, and just a general sense of, hey, how's it going? Anything we should be concerned about? And all things are good. Then we take the paperwork and say, thank you very much, and we'll call you next year. You probably sick of these guys calling you every year saying, hey, how are things going? Can you send me your numbers? And it's, oh, here we go again. What's coming? It's not a surprise. And people ask me, like, oh, they're going to call me. I'm like, don't think, it's not an inquisition. It's part of our duty. We're required to do this. As far as our requirements as a lender in Canada, CMHC wants to know that we're checking on it. And I'm not saying I use the analogy. It's like the old analogy of the airport. Every time you go through the airport, you got to empty out your water. Well, why is that? It's because somebody one time did something super ridiculous and unfortunately had something happen. So now everybody's got to empty their stuff out. You got to take off your shoes. And so we have to do these checks on an annual basis to make sure that we're compliant, because at the end of the day, like we talk about the affordability, we check that. That's how we do it, is, hey, if you're seeing that your rents are through the roof, and we're going, how did that happen?
What would happen in that case?
Call the loan.
You recall the loan?
We could if you don't remedy it. Like, we're not going to do that first. They could come back if you don't want to deal with us or you're not being reasonable. Yeah, we can call the loan.
What would that look like? I'm just curious.
You're going to get a lot of interesting paperwork from lawyers saying, pay us back our money, sell it, or finance it another way, but we want our money back. Now, I've never personally seen that, and hopefully, again, I don't have any wood nearby, but knock on wood, I never will. But yeah, that's what would happen if you don't want to be compliant, and particularly with regards to CMHC, because they'll pull the insurance. And if we're not compliant with insurance, we have no coverage. It's like driving around a car with no insurance. If something happens, we're cooked. And us as a lender, you don't survive by having loans that are not compliant.
I also want to talk about what kind of buildings off the bat will qualify just on first glance versus aren't, or are going to be more difficult to qualify. Is it a price point? Is it an age? Is it a location?
A lot of these new builds, I think we mentioned earlier, get qualified for this. It's just because the fact you don't require to have as many for affordable, for designation. Like 2 basement suites out of 8, it's nothing. That means your other 4 basement suites, and if you could get to them $1,800, you could do it. Not that you can, but you're very much free to do. So I think they're a little bit easier. The older buildings, the reason why I say that they're more typical for that, buildings that have been around for a couple of years or longer, is because you require more of the units to be affordable, or if you're retrofitting other things, it's very costly, and it's an expense up front that eats into your capital day one, which, to me, do it if you want. I'm not here to stop anybody. You're not just, you can't do it. It's just harder to dig in your own pocket to fire more money out. The other thing about older buildings, again, I don't want to sound like I'm against legacy properties, but they do often require building inspection reports, condition reports that are available. And there can be challenges in there that we need to factor for. And I've seen some buildings where maybe it does require a lot of work. And we've done some scenarios where it's like we need to reduce the loan amount because there's some or holdbacks because it's just there's some work in here. The boiler is going or the roof is going or the electrical really needs an update or something to that effect. And it doesn't happen all that much. There are opportunities where that can happen. I'm not sure. Does that kind of answer the difference? I'm
Yeah.
not sure, but
So
it's just different
in
challenges, right?
general, it is easier. It's still a long process, but in general, it is easier to qualify a new construction building than an old one.
Yeah.
And then if you are purchasing an old one, it has to be in really good shape.
We would look at the operation statements and maintenance records. We want to know that have an understanding. When was a roof last done? I know that I've been out to a number of site inspections where they're going to get on the roof, and I am afraid of heights. And I looked at it and going, looks fine to me. When was the roof last done? That's very important. These roofs, particularly some of the bigger buildings, are flat roofs. Those are not cheap. They're not cheap. I'm sure you've seen them. They're not cheap fixes. So if the work needs to be done on them, these are big ticket items. And so these are challenges that I would suggest that first time maybe investors would. I'm not saying don't do it. Again, I'll never tell anybody, steer anybody away. It's just that there may be other paths that you can go first, get your feet wet. And then if you want to look at some of this, because the other thing about legacy buildings, in some cases, like I just mentioned before, I'm not trying to be facetious, but like the mom and pop, the rents may be well under, and you could come in and over a number of months really put them back up, and the building could be a gem. So you definitely don't want to discount those buildings either. They just come with other challenges, no different than brand new would, where you're paying a premium for the building. It's brand new, but they're sometimes in maybe not as central locations. Like some of the places that we've looked at, I've been on site inspections out in like places like Matson or Meltwater. I think another one that's out there. You're outside the city looking at brand new places, but they're a haul into downtown if you work downtown. So it's like advantage to disadvantage. I think a lot of it depends on the investor appetite. A lot of people want to get in and do a bunch of work, and I'm always cautious. Okay, make sure you understand what you're getting into.
It's a very common strategy that people want to adopt where they will purchase a 1960, maybe 8 to 12 unit apartment building here in Alberta, wood frame, walk up, no elevator. They want to buy this old, let's say it's an 8 unit and list price is 860. They want to buy it through MLI Select, and then they want to renovate it and then requalify for MLI Select afterwards. What would that okay, let's start here. Would an $860,000 8 unit rundown apartment, 1960 build, be a good candidate for MLI Select? Let's start there.
Look, $100,000 deal, like purchase price in this space, is pretty small in the grand scheme of things. Now, as far as its ability to qualify, I'm sure it could qualify if the numbers work.
Do you think I could get it for 5% down?
Potentially, yeah, but you'd have to have more of the units affordable, right? Because it's going to be an existing building, so you might need to. You're probably going to have 7 of those 8 units to be affordable. So I think if you can work your numbers and understand that if you can make a cash flow and it still qualifies and you're good with that, then absolutely. In the cases where I'm seeing the strategy around that one that I've typically seen, I've looked at a bunch of these and I'm still waiting for someone to finish one of these deals, is where you buy something like that, you put down 25%. We do a bridge. You go in with cash, do the renovations you want, release it back up, and then we go to CMHC with the increased rents, and then you'll get the higher loan to value because you've done the work.
In that case, would I be paying if I was purchasing this building? So I'd be purchasing it with a conventional loan of 25% down, and that would just be temporary until my renovations were complete. Where's the renovation money coming from? Is that cash, or am I getting another loan for that?
Cash.
So I'm paying for renovations in cash, which is going to be a lot of money, like anywhere from 20 to I've seen up to 60K
per unit. Yeah.
So it can be a heavy hitter, and it's going to take longer than whatever the contractor tells you. I guarantee it.
It's only 30 days.
Yeah, only 30 days to completely haul these units over.
Yeah.
So once my renovations are complete, do I then need to fill in the tenancies and then apply for CMHC MLI Select?
That's what I'd recommend. Get the property stabilized, get it fully rented up, and then we would go in. So that's why I think it's just caution, because we HGTV and all those guys, and I'm not knocking the work they do, but they romanticize, just do all these wonderful renovations and you'll make top dollar. You got to come up with that money. You got to be able to carry the cost. You got to be able to do a lot of logistics. And I just think first time investors, I think it's a big ask. And I think we as an organization, like one of the times I saw something similar in Edmonton. Was the guy was very experienced. He did it and then did it, but he did it all in cash himself. Another guy came to me and it was similar story. And he goes, "Wow, my uncle does a lot of this work." And I'm like, no. And he said, "Well, my uncle and I can do it." I said, "That's fine. Like, I'm not knocking the work he can do. It's just we don't have enough cash here and the experience isn't there. You haven't done this before." And you can say, "How do I learn if I don't do it?" Unfortunately, you got to use private money or other ways to get there. Typically, a lot of times, so you can go up the line. But because construction is, at the end of the day, is the most risky financing thing in this space, in my opinion, anyway, because a lot can go wrong. There's just so many variables in there. I'm not saying people can't do it. I'm not at all saying that, but I'm just saying from a first-time investor, that wouldn't be my, hey, go grab one of these old buildings that needs a lot of love and a lot of work and boot all the tenants out, have no money coming in and start ripping apart wiring and plumbing and flooring and kitchens and bathrooms and windows and roofs. And it's a big ask. And I think there's so much romanticism. That's a word.
Yeah, I think that's a perfect
around
word
construction.
for it.
You
And
know,
then if
yeah.
you are doing that process, then your hope is once you refinance through CMHC and lock that in, then the amount that you get appraised for will basically pay you back for the construction costs that you sunk in there.
You hope to get your money out. Yeah.
Yeah, you're hoping to get all of your money back out, and that'd be great if you get it for a profit as well. If you get some spread in there.
If that works for you, then yeah. I just don't know, and I hate the idea of people going in with the I'll do all this work and I'm gonna make an extra $100,000 or something. That's what makes lenders nervous. You're not just trying to improve it to make money from the unit. You're also looking to make some cream on top. And I just think that there's some hesitation around the idea of, okay, they're not just doing this for the sake of making the building better, make more money. They want to make a cream on top of that. And that sometimes like it makes me personally nervous if I were sitting in their shoes and going, okay, you want to hit a home run, I'm all for it. But it's just the scenario seems to be it'd be tough. Brand new.
What I tell people as well, because I agree on paper that strategy is brilliant. It's awesome. And there's a lot of people that aren't willing to do that work. So there is money to be made there. But if it's your first multifamily building and or if you're out of province and it's your first multifamily building doing this. So I tell people exactly what you said. If this is where you are confident in going and this is a strategy that was going to be a home run, I will help you find a property that fits that. Yeah. But if you aren't 100% confident in your ability to do this, I do think it would be better to just go for a turnkey investment. The financing alone is going to be so new for you. Yeah. Start with something easy and then grow and bite more off with your properties.
Yeah. And I think it's a sound strategy. Like it's from a residential, let's make an example. Like instead of, this happened a lot, unfortunately, to some of the people I know over my life where they went to go buy their first home, like whether it be as a married couple or whatever the case may be. And they bought buy these huge houses. And I'm going, okay. And it worked and the numbers worked, but then they found themselves cash poor later. Because it was like, geez, we got this house. And my father, and much as I don't want to give him too much credit, he would say, well, we started out in an apartment. We went to a townhome or like a duplex. Then we went to a bungalow and then we went to a 2-story. It was done in stages and they learned as they went along and you didn't bite off more than you can chew. Where like you don't want to go into your first round and go like the hardest possible scenario and then go, this should work out great. And I think that's how partnerships dissolve or divorces happen. I say that tongue in cheek, but like you're taking on the hardest possible scenario and hoping it's going to hope for the best of work. You've done a couple and you've got some partnerships in the industry. You've got another like a JV or something you can do with someone who's experienced. By all means, do that. But if you're looking for your first one, try something that looks on paper, looks solid. You're not going to have to pump a lot of capital into it to start. That would be good.
Yeah. I think it's a beautiful strategy in order to burr an apartment building. That's super impressive. That's a lot of work and it can be profitable, but that's what I used to do. I used to be in a renovation company that would renovate entire apartment buildings and it took a long time. Yeah. And one of the buildings we did $60,000 per door and it was an 18 unit. That are some deep pockets. It's just so complicated. Why not make it easy on yourself from the beginning? And then once you gain confidence, bite more off, then bite more off. And then you can start chasing the spread. But to start off.
Or at the end of the day, you build a portfolio. And then I think some investors, and you could speak to this more, when they get their bailiwick, they find their lane. I really like this kind of property. Or I like this number. Or we prefer this part of the city, or I don't like buildings that are close to I don't know, main drags. We prefer ones that are closer to schools. We like renting to families. Everybody finds their lane, I think, at some point. And so I think the idea of you go after the hardest one to start, and particularly one that's so cash and $60K a door, then I don't know what the price per square foot on that would be. That's still a lot of money. And the time. And then when you go to rent it up, and is it still a construction zone? And there's so much logistical things that I can only imagine. And again, if you got that expertise, 100%. But a lot of those people that have those expertise, they got battle scars. They've gone through it. They've had some fails or some things, but they've learned, and then they're worth their weight in gold if you want to engage those folks. But yeah, 100% turnkey first round. Maybe, I don't know what the magic number is for everybody. It's different, 8, 10, 12 plex, whatever you want to look at. It depends on the size of the investor or the group, but there's ways of doing it. And with the programming, you can do it not that long, where you can really have a portfolio, a decent sized portfolio, not too long a period of time. And particularly if you're doing the new build stuff, the thing that I like about that part is, at least I know you shouldn't have any major bills. I mean, there shouldn't be much CapEx the first,
yeah, it's not a 1950s boiler that just was covered in asbestos.
Yeah, like seriously, everything should be under warranty for the foreseeable future. And the other thing I've been saying to a couple of these people, like, what do you think? I said, at the end of the day, I think you should get a premium for your rent just because you got a brand new property. People are walking in the door going, look, I got brand new new carpet smell. The kitchens are new. There's some advantages to that for sure. I think
that is a great note on that, because when you have a newer building, you are able to charge more. Just naturally, tenants are going to migrate to have a nicer, newer property to call their home. And then typically you'll also see more stable tenants because you'll have a higher rent amount. It's not just helping you out to start off with the maintenance costs, but that's going to help you for years to come to attract the kind of tenants that you want. Like, if you want good tenants with very low turnover, then get a good property. It'll speak for itself and people will want to call it home for years to come. If things are consistently breaking, it's very outdated. Maintenance, they're always shutting the water off because there's always some plumbing issue that needs to get addressed in this old building. Like, that's going to keep maybe the kind of tenants that you don't want. And it's all depending on your strategy, but it's more than just the purchase price.
Yeah, no, I couldn't agree with you more. And yeah, where you can give yourself an advantage, you got to try. And I'm not saying it's the only way of doing it. Of course, I think you got to do what makes sense for you and your investor group or your strategy. I think that's important. I think there's opportunities. I think you got to take advantage where you can, why you can, because anything else, things change.
So you've said that to date, you have 100% track record. I got one here for you. So to me, what I heard was all of the applications Andrew has applied for have gone through, but there must have been some clients that have come up to you saying, Andrew, I want to buy this through CMHC MLI Select. And you're like, hey, man, it's just not reasonable. I wouldn't recommend you putting the application in. Have you come across clients like that or deals like that?
Lots.
So is it typically based on the property or on the person or the applicants themselves?
Both. I can think of an example over Christmas where a investor came through me, and we looked at his net worth for what he wanted to buy, and the numbers were too tight. He's not ready. So what he did was, okay, I'll just come back in 6 months. He's a medical professional. I don't doubt in my mind that he'll be back. He just needs some more time to save up some more cash. In some cases, I got all my money in my RSP for part of the net worth. In this case, RSP, you can only use half. Yeah. So that was something he didn't know. And I was like, I said, fill up your TFSA if you want to do it the other way around. He's okay. So he'll go off and do that. But he didn't know the rule, obviously, because that's something it's public information, but it's not something everybody knows. So there's an example of someone that they weren't ready because of that. I had another guy call me and we had a conversation, and it was, we needed his spouse on it, and he didn't want his spouse on the deal. And I said, okay, the numbers don't work without it. And again, it came down to net worth. That was an example. She made quite a bit more money than him. I'm not too sure what the rationale was, but that was his personal choice. So there's 2 examples. And another one, there's been a couple buildings recently I've looked at where, based on the rents and the purchase price, like, they didn't line up. I think the loan amount in the last one I looked at that I said that we couldn't do, it's inaccurate. We could do it. It's just, I think the loan to value, based on the numbers I had on my underwriting, was 89% loan to value. So they need to put down 11%. He's like, I don't want to do deals. I said, then don't do it. Like, it's really that simple. If I look at the numbers and they don't support the number you're satisfied with for down payment. I know we talk a lot about 5%, and I do want to be conscious of that, because it's not everything is. And it may be the case where you got to put 7 or 6 or 8 or 9 or 10. if that still works for your strategy and the numbers you're still happy with, do it. I'm not saying no, but in that case there, he's like, well, I don't want to put 11% down. I said, then don't do the deal. Like this is not, the underwriting on this doesn't work, which is what's important, because at the end of the day, if he wanted 5%, that's the only reason he would do the deal. So he walked. So go find something else. So a lot of those folks that I say other doesn't work now, it's like some cases just go find a better building or a different building or a lower purchase price, or in some cases either bring another partner on or take more time to save up your liquidity. So there's things you can do. And then those are very easy to have happen, where it's no harm, no foul. Walk up and get a quick answer and then go back and fix it. That's easy. So that does happen. And it happens more than I probably even thought it was originally, because I have a lot of these conversations. But I'd rather have those day one than, hey, we waived my conditions. We're hooped. What do we do? I don't ever want to find myself in those scenarios. And how we do that is by making sure we're trying our best upfront to look at all the information. And if it all adds up and it fits in the box, then why won't it work?
Another option too is if it's net worth issue on why MLI Select might not be the best fit, is there is no shame in continuing to invest in residential. As that residential property gets paid off, that is making you a stronger applicant for your net worth for MLI Select. Right. So it's not, oh, I couldn't do MLI Select, so I'm stuck with residential. It's I am building my residential to make me stronger for MLI Select.
Right. Yeah. No, I guess I mentioned those folks earlier that I was talking about who buying the 20 or 21 unit building. I can't remember, but yeah, they had a duplex and a triplex. They make good money. They've got good equity in it. That helps their portfolio. That factors in. That's important, and it shows they have experience. So these are things you can do as a stepping stone. You don't have to go right out and get a $3 million flex today. That's not what you have to do. If you can, then go for it. I'm not saying don't, but there's other ways of getting there. And I think it's a good point. Don't be discouraged. You can go the other way as well. It may take you a little longer, but if you get there in the end, so be it.
Yeah. So one last question that I want to ask you is residential versus commercial loan rates. I don't know if you know residential because you don't transact in that anymore, but on average, is commercial loan rates higher or lower than residential?
That's a really good question. I don't have a residential rate in front of me, but someone could do that a little bit better.
Let's search it up right now. I'll
you got me on that one. But I can give you an example. Let's do this. So when you're looking at pricing in this space, and I've had this conversation with a lot of new investors, and they're throwing off a little bit, because when we price stuff out, it's based on the commercial backed mortgages, right? So it's a bond rate, and that rate changes daily. And we price it off of a spread off of that. So for example, I could quote you a 10-year fixed, I'm going to use the word again, just CMB plus say 110. The 10-year rate, and I'm just looking at my screen here, today was 3.55. So that would get you, so that would get you 4.65.
Yeah, because that's prime
on a 10-year today.
I'm just looking at a 5-year fixed rate mortgage here. It says RBC right now is at 4.89, 5.09, 4.59, 4.84 at National Bank. So on average, it's going to be at least equitable to where residential is, but potentially less even.
Depends on what we're comparing it to. But yeah, if you were to buy, like if you said, hey, I want to buy that example, we said $1.25 million fourplex, you're not getting 4.64 or whatever it is from the bank. They price up rental properties. So you're going to probably get quarter point above it. So 4.89 or something like that, because they bump up the pricing on rentals. So
one last note on investing in residential versus commercial. When you're investing in residential, a lot of your competition as a buyer are primary home buyers. Barrier of entry in residential is a lot lower than it is in commercial. So you just have so much more competition in residential that you are offering against another buyer who is maybe more emotional about it, or they are willing to spend more money past the numbers making sense to them because they have their own reasons. But when you're purchasing in commercial, you're only competing against other investors, and there's less of them than there are families. So you can negotiate better deals. You're much more likely to negotiate $100K off of a $2.2 million building than you are to negotiate $100K off of a $400,000 house, right?
Yeah,
this is a different space.
The pool is smaller. The pool is much smaller.
Those are all of my questions for you. Thank you so much. We had some really good conversations in there.
Yeah, that worked out. I'm glad we could do it.
So Andrew is a lender, not a broker.
Yeah.
A lender, not a broker. I
Thank you
called
for
him a
clarifying.
broker
That's
by
good. Yeah.
accident
I talk
before.
like a broker. I can be careful. People are like, oh, you're a broker. I'm like, no, I'm not a broker. I used to be, so I gotta stop talking like that. I don't know how I fixed it, but
So he's great. He works directly for the lender, Peak Hill Capital. They are great as they are the lender themselves. They would be providing you any bridge loans if that's how your deal was structured. And I think the biggest highlight, you have a 100% track record to date.
yeah.
And
Definitely
that's incredible. You are specializing in MLI Select program, so you are the professional that people can trust to go to about this. This isn't your first deal that you're trying to figure out. You're seasoned by now.
more than I thought it'd be.
Yeah, so you're seasoned and you understand all the layers to these deals, and you're really great with people and clients as well and explaining things if it is their first time. So yeah, 10 out of 10.
Thank you. I
Can't
really
recommend
appreciate
you
that.
enough.
Thank you.
Do you want to plug yourself a little bit? How can people reach you?
You can give me a call. I just have my cell phone number. So it's 403-771-0134. Or you can reach me an email. It's Andrew Galler, all one word, at peakhillcapital.com.
Perfect. And does it matter if there is an investor that's from Ontario and you are here in Alberta?
Nope, doing a lot of that. I joked the other day that I see more 905, 416, and so what is it, 778 numbers on my phone than I do 403 or 780 numbers. So it's anywhere in the country, right across the board. Alberta, BC. Obviously, Alberta is my focus because it's where I live and I work. But we're happy to look at anything, anywhere.
Thank you so much, Andrew. This was a great conversation. I'm super excited to smash this all together and share it with everybody.
Awesome. Thank you very much for having me, Megan. Really appreciate it.
Have a wonderful day.
You too. Bye for now.
Thank you again to Andrew Galler for joining me as the guest on this episode. He was the perfect person to talk about residential versus MLI Select financing. You can reach Andrew either through his email here, or you can also give him a text or give him a call through his number here. He's always available, and his response rate is crazy fast. I hope you guys learned some quality information while listening, and I hope you have a great day. Peace out.